What is fundamental analysis? Fundamental analysis is the process of examining all of a company's fundamentals, both quantitative and qualitative, to determine the real or intrinsic value of a stock. This value can then be compared to the price the stock is currently trading at to make strategic investment decisions. What is the main assumption of fundamental analysis? Traders who use fundamental analysis assume that the market does not always value all stocks accurately. This is antithetical to the efficient market hypothesis, which assumes all stocks are accurately valued at all times. More on this below. What is fundamental analysis used for? Investors and institutions often use fundamental analysis to get a more accurate picture of a company's intrinsic value. Here, intrinsic value refers to the true worth of a company, rather than its market value, based on the many factors that contribute to its health and success. Investors who prefer fundamental analysis to technical analysis, more on this below, believe that the price of a company's stock isn't always an accurate gauge of the company's value. By conducting fundamental analysis, an investor can identify a stock they believe is undervalued by the market and choose to invest in it with the hope that it will rise in price in the long term as the company's value becomes apparent to the market over time. Similarly, an investor could choose to sell a stock they've been holding that has gone up in price because fundamental analysis tells them that it is now overvalued by the market. How does fundamental analysis differ from technical analysis? As mentioned above, fundamental analysis is based on the assumption that the market doesn't always accurately value all stocks. Traders who use the technique try to identify and purchase companies that are undervalued with the expectation that they will eventually trade higher as the market at large recognizes their worth. Technical analysis, on the other hand, is the process of making trading decisions by evaluating price trends and patterns rather than examining a company's fundamentals. This technique is based on the efficient market hypothesis, which assumes that a company's fundamentals directly inform the price its stock trades at because all relevant information is always available to all traders. From the standpoint of the efficient market hypothesis, fundamental analysis is unnecessary, as all stocks are accurately valued at all times, so trading decisions are best made based on trend evaluation and pattern recognition. Traders who use technical analysis spend much of their research time looking at candlestick charts and historical data to make predictions rather than evaluating company-specific metrics like cash flow and earnings growth. What are the quantitative components of a stock's fundamentals? Many important fundamentals are publicly available quantitative metrics that can be compared between stocks within an industry. Comparing quantitative fundamentals between stocks in different industries provides less insight, as different industries have different norms. Below are some of the most common quantitative metrics used in fundamental analysis. Earnings per share, EPS. Earnings per share is a metric that expresses a company's annual profit per share of its stock. To calculate EPS, a company's net income, after preferred dividends, is divided by the total number of shares outstanding. EPS equals earnings, preferred dividends, number of shares outstanding. Price to earnings, P/E ratio. The price to earnings ratio is a metric that expresses the current price of a share of a company's stock in terms of its EPS, earnings per share. It is essentially the price investors pay for $1 of earnings per year. To calculate this metric, share price is divided by annual earnings per share. P/E ratio equals share price, earnings per share. Price to sales, PS, ratio. The price-to-sales ratio compares a company's share price to its annual sales revenue. This metric does not take profit, earnings, into account. To calculate this metric, share price is divided by annual sales per share. P/S ratio equals share price, sales per share. Price to book, PB, ratio. The price-to-book ratio compares a company's market value, market cap, to its book value, assets minus liabilities. To calculate this metric, share price is divided by book value per share. P/B ratio equals share price, book value per share. Debt to equity, DE, ratio. The debt-to-equity ratio compares a company's liabilities, debt, to its shareholder equity to determine the degree to which its operations are funded internally versus externally. To calculate this metric, a company's total liabilities are divided by its shareholders' equity. D/A ratio equals liabilities, shareholder equity. Projected earnings growth, PEG, ratio. The projected earnings growth ratio compares a company's price to earnings, P/A, ratio to its growth rate. To calculate this metric, a company's P/A ratio is divided by its growth rate, as a whole number percentage. PEG ratio equals P/A ratio, growth rate. Free cash flow, FCF. Free cash flow is essentially the cash brought in by a company's operations minus the cash it spends to support those operations and maintain its assets. This metric takes into account any changes to working capital. Dividend yield. Dividend yield is a metric that expresses the percentage of a company's stock price that is paid out annually to each shareholder in dividends. To calculate this metric, annual dividends paid per share are divided by the current share price. Dividend yield equals dividends paid per share price. Dividend payout ratio. The dividend payout ratio is the percentage of income a company passes on to its shareholders in the form of dividends. This metric is calculated by dividing the total amount of dividends paid by a company's total earnings, income. Dividend payout ratio equals dividends per share, earning per share. Return on equity, ROE. Return on equity compares a company's income to its shareholders' equity. This metric is calculated by dividing a company's net income by its average shareholder equity during the period in question. ROE equals net income, shareholder equity. Please like, subscribe and share our videos.